Hey guys, so welcome to the next video in the course. And in this one, we're going to be looking at inducements. Now, this is a topic that generally comes up quite often because there's a lot of times I even see in the Discord community, you might get into a trade and then let's just say we go break even or something and then price comes to take us out, but still go back in the same direction. Now, this is something that catches out a lot of traders. So I just want to explain a few things regarding it and then what we can actually do about it. Okay, so inducements. One thing you've got to understand, they happen all over the place, and that's what they're there for. They're there to take the stop losses. In the whole sort of theory of smart money concepts, the reason why an inducement takes place is because there's resting liquidity above that area or below that area, depending on which side of the market you're on. There's resting liquidity above or below that area, which is what we call buy side or sell side liquidity. And then eventually does take them stop losses and then reverses in the same direction it was already heading. So what we need to do is we need to identify when it happens and actually use it to our advantage as well. But how can we actually do this? And I'm going to explain it in this little case study here. So we're going to be looking at GBP USD on a 30-minute chart. Now, as you can see, let's just observe that all of this in a technical analysis approach. So market structure generally is looking quite bullish. As you can see, we've got high highs, higher lows, higher highs. Now we're looking to have that higher low. In terms of liquidity, we do have equal highs at the top to aim for. And then, of course, we've got imbalances over here to be filled, all of that inefficient price action. Then in terms of entries, we do have this demand zone below the imbalance. So if I was on the high, this is obviously 30-minute time frame, but if you're on, I believe it's the 2 hour, 4 hour, you do get this nice order block that appears right here. But when you go down to 30-minute, it becomes a bit more refined. So these are potentially the two areas that you could look at in terms of order blocks. So we've got the first one that is literally just below the main imbalance on the higher time frame. Then we've got one to the bottom, which is more of the extreme one as well. But both areas you could say are quite valid. Now, in this case, let's just say, as a trader, you've entered that first area for the buy as a limit. And then what happens? Price creates that sell-side liquidity right there, right? Anytime you create a high or a low of a range, you're going to instantly create liquidity just below it. That's technically what buy side and sell side liquidity is meant to represent. For example, at the top over here, we've got buy side liquidity. So if we were in this bullish structure, eventually, if we got into a buy around this area, one of your take profits is going to be up here because that's the top of the range. But let's just say, for example, price played out a bit more, but eventually price came back to take this liquidity right here. The whole general 4 hour zone was still respected, but it was the lower area that we were looking at. So as you can see, if you had entered the lower area afterwards, this is what it would have panned out to be. What I'm trying to say here is this. When you do get into an entry like this, for example, eventually you're going to be set at break even, right? So price takes you out at break even, but because we're still respecting the higher time frame zone, it doesn't mean that we should disregard the buys anymore. So this is why I would still say within this high time frame area, even if you get induced on that first buy, you could still say this buy right here is still valid, right? Because you're still respecting the higher time frame, but you've only been induced on the lower time frame right there. So that's low has been taken, but the higher time frame zone has still been respected. So what are the takeaway points that I really want to bring across here? If you get induced, but the pullback still remains within the higher time frame point of interest, then you can still safely assume that the original trade direction can play out. One thing that makes this more apparent to me or a lot clearer is when we're in this trade and let's just say, for example, in that first area, price only rejects a tiny bit, comes down, and it doesn't really break any primary structure or anything like that. I'm still expecting price to, come back up above this initial entry into that higher time frame point of interest. I can still expect that to happen. If, for example, we had got a primary structural breakdown and then it starts to retrace a bit, I'm not really expecting an inducement to happen. So if that did happen, a primary structural break, and then inducement happened, I would be quite wary about entering anymore. I would only really want to do it if we haven't really broken a lot of structure downwards, because we're still pretty much fighting within this zone. Sometimes it's hard to avoid or predict the inducement is coming, but the only thing you can do, and this is generally the only way you can protect yourself from an inducement, is go to break even at a good point. We talked about that in the last lesson. Or for your original entry, keep the stop loss wide enough. So like I say, first solution is this. When you're in this trade, as soon as you can, when it breaks a secondary structure to the downside, any of this lower time frame structure here, put your stop loss at break even. So whatever happens, happens. Or the second option is this. The high time frame point of interest, you just put a limit right there, stop loss above there. So now you're protected whatever happens. Obviously, people that do like to trade a bit more aggressively with a higher risk to reward are going to prefer the first method. But that's pretty much all you can do. I mean, like I said from the start, with inducements, the whole point of them is for the market to take the stop losses. It's going to happen time and time again, and there's not much you can do about it. All we have to do is just react and see, is our higher time frame point of interest still respected? Let's just say, for example, price continued upwards to the top and induced just the top. I wouldn't really consider this point of interest as valid anymore. You see what I mean? There are scenarios, of course, where you do get a bit of that buy side liquidity just induced, tiny bit, and then it drops. But that's not really something that's a good confirmation for me, as when you compare it to something like this. But yeah, guys, that's it for this lesson. Hope you enjoy this one. I hope it does clear up just a few things that you might have had in your mind thinking about all of this. Why are my stop losses getting taken and then we're still reversing in the same direction? But that's pretty much it for this lesson. I'll see you all in the next one. Take care.